So, good evening, friends. Hope you are taking full benefits of these live virtual revision classes of Final Paper 4, Direct Tax Laws and International Taxation. Again, today with us, the expert faculty, Prerna Kashori ma'am, and she is going to continue with the topic assessment of various entities, then moving forward to the next topic. Before moving to our the technical things, again I am came here with some MCQs which I want you people to solve, right? And these are based on the contents which we have already discussed in the earlier classes. Of course, there may be something which are not discussed in the revisionary classes, but which were discussed in your detailed versions of the classes, right? So, but I am waiting for some more students to join so that they can solve these classes. Today, I am not going to share the link with you. The screen is before you, and the MCQs are there. Now, I think only two persons has joined, but I feel that some more should join. Prerna, I think we can wait for some time.
We can wait for 1 or 2 more minutes.
Whoever the students are there, just let me read the first MCQ. These are very good MCQs, of course, and you have to apply your mind. I will be giving you some time to solve it. Let me read these MCQs for you. Whoever the students are joining, they can continue the class from there, right? So let me take up what this MCQs is about. This MCQ here in this case, Mr. Hari has an income of 52 lakhs under the head PGBP. He is having income of 52 lakhs under the head PGBP, and he is having one of his business which is eligible for deduction under section 80 IA at the rate 100% for the assessment year 25-26. The profit from such business means the eligible business under section 80 IA is included in the business income of 52 lakhs of rupee 35 lakhs, right? So, what would be the tax liability? I am simply asking you to determine the tax liability of Mr. Hari for the assessment year 25-26, assuming that he has no other income during the previous year 24-25 and he is exercising the option to shift out of the default tax regime under section 115 BAC. The options are given before you. So, some students have joined. Akshay, Siddharth, Smriti, and the students who have joined through not through the our Zoom link, but they are available on our admin portal and the BUS Knowledge portal. So those also can please reply through that portal itself. I am just waiting for you. The first option is rupee 3,35,400. The second option is 10 lakh 480. Then the third is 11 lakh 530. Then the D option is 11 lakh 50,550. So what would be the correct answer? Those who have joined, please answer me. You can just unmute your self and answer, or if you want, you can write it your answers on the chat. Isn't computational problem? Please compute it. I hope my screen is properly visible to you.
Yes, ma'am.
Ma'am, I think it is option C.
See, okay. Let's wait for others also. Who has given this answer? Akshay. Okay. What about Siddharth? Smriti is saying option C. Okay. And Siddharth, you also do it? Siddharth, are you able to derive at the answer? Don't think that this option C only would be available. You please apply your mind. How, if it's option C, then why? And if it's not in option C, then why? What's the reason? It's option A. Okay. So, Smriti, can you explain why it's option C? I want you people so that I should come to know what is the reason why you have ticked for option C. Smriti, would you like to explain or may I do? Akshay, you want to?
Yes, ma'am.
Yeah, you explain.
Ma'am, the SSC has shifted out from the default regime,
Yeah,
and therefore it will be under old slabs, that is 2.5 lakh slab,
yes,
on the normal basis.
yeah,
Upon that calculation, we would get after cess tax would be 3,35,400.
yes.
But as the SSC is availing the benefit of Section 80IA, a profit-based deduction, uh, he is eligible to be applied for AMT.
Yeah, the provisions
Alternative income
IMT
tax.
would come into picture. Here, even though the question is simply saying that you have to compute the tax liability, but the Mr. Hari is claiming the deduction under Section 80 IA, right? And its adjusted total income is exceeding 20 lakh rupees. In that case, what will happen? What will happen? The provisions of AMT would get attracted. In that case, what you have to do, you have to, if the AMT liability is higher than your normal provisions liability, then the SSA is required to pay the tax as per the AMT, right? So on that income, that is 52 lakhs, you have to compute the AMT, right? 52 lakh would become, you will not be eligible for this ATIA deduction. It has to be added back. Otherwise, what would be your total income? In the norm, as per the normal provision, it is 52 minus 35. You will get the 100% reduction. It is coming to 17 lakhs. Accordingly, if you compute as per the normal provision, then the tax liability would comes to 3,35,400. However, the provisions of section this AMT provisions would get attracted. In that case, the SSA is required to pay the tax at the rate of 80.5% plus. Since it's adjusted total income, that become your total income exceeds 50 lakh rupees. So 10% surcharge would also be applicable, and then on that 4% cess would be applicable. Accordingly, the answer would be C, right? Now let's move to the second question. I have to reduce its size. First, let me read this question. Is it visible? Siddharth, you understood. Very good. So it is not only the MCQs. It happens because what is happening now when we are doing the descriptive questions, it's general trend. When we are doing the descriptive question, it doesn't came to our mind because here options are given. So it is very easy कि आपको थोड़ा बहुत mind में click कर जाए कि there is a possibility of AMT also. But when you are doing descriptive ना, it happens certain times कि आप पूरा question solve कर लोगे. You have to apply the all the deductions, everything. But at the end of computing your tax liability, you have to identify कि yes, AMT provision would be attracted or not. This question, this requirement would not be clearly given in your answer, but it's a hidden information. Based on hidden information, you have to identify and apply the provisions of AMT as well, right? But if it is shifting out of the default tax regime, then the provisions of AMT are not attracted. There is no question of your AMT, right? In that case, but the deduction under Section 80I would not be available in that case, is it? Now, the second question is on 115 BAC. It is talking about which of the following deductions, exemptions, set off of losses are allowable while computing income under respective head of income and total income of an individual as per Section BAC. As per Section BAC. You have to tell me what are the deductions, exemptions, and set off are allowed. So certain deduction and exemptions are given in these following points. Deduction for interest on housing loan in respect of self-occupied property. It is in respect of self-occupied property. Then interest on housing loan in respect of let-out property. And then exemption in respect of agricultural income, right? Exemption in respect of minor child income, and then the set off of losses under the head house property against income. Last one is the standard deduction under section 16(1)(a). Now you just tell me, I'm not showing you the options, you just tell me which all exemptions or deduction are allowable and as if the assessee is paying tax as per 115 BAC. You just tell me. Smriti, no AMT would be applied in that case. Yes, if the person is paying tax under the 115 BAC, no AMT provisions are applicable in that case. You tell me which all deduction or exemptions are available. 1, 2, 3, 4, 5, 6. Which all are allowable? I'm not sure, but it's 2, 3, and 6. 2, 3, and 6. What about others? You also please tell me. Hope you all understand this question. See, 150 वैसे for example the first question let me tell you आप थोड़ा एक समझ लो इसको. I think second and third ma'am. Okay, Siddharth. And what about the other persons? See, let out property will be allowed. I will explain you. Smriti, see, self-occupied, while computing the income under that house property. See, house property is not covered in your detail at the final label, and salary is also not covered in detail. However, these provisions which are given in your basic concepts, the overview of these things, and you are a final student, so you are expected to be aware of the provisions of salaries as well as the income from house property. The brief of this is given in your basic concept chapter 1. Okay. Now, these aspects basically are tested in your questions which are related to double taxation relief basically because it covers the individual provisions. Otherwise, आप देखोगे आपका जो first full-fledged question होगा 14 marks का, it is from on testing the companies or the partnership firms or the cooperative society. It can be on these aspects basically, and the individual की full-fledged computation of total income and tax liability are not tested basically in this assessment of various entity chapter, but it can be tested in your double taxation relief or the non-resident taxation. So this provision is important from that aspects, right? So here, if you see the 115 BAC, deduction for interest on housing in respect of house property, when you are computing the income under that house property, you will not be allowed the deduction in respect of house property itself, self-occupied property. But let out property is allowable under the head house property, but this set off is not allowable under the head others from the other heads of income. This is a tricky point, that the interest is allowable while computing a house property income, but this set off of losses, when something is arising as a loss from the house property, that loss is not allowable from the other heads of income if the assessee is paying tax under section 15 BAC. So it is allowable. This deduction is allowable. Interest की बात कर रहे हैं यहाँ पे हम. Interest की deduction कहाँ पे arise होगी? Interest की deduction arise होगी income from house property, not this set off of losses. Set off of losses में restriction है, not in the interest on housing loan. ठीक है, interest on housing loan की deduction will be available only when you are computing the income under that house property, right? Then exemption in respect of agricultural income, definitely you can claim, there is no restriction on it. Minor child, 1032 is not allowable, right? 1032 is not allowable. Then set off of loss, यहाँ पे the problem is arising here. They are not allowing you to set off the loss of house property, right? So it is not allowable. Then stand deduction. BAC में क्या stand deduction है? May I ask you this question to you? It is definitely not pertaining to this MCQ. May I ask you what is the stand deduction available under section 115 BAC? Siddharth, you are very fast. but it's not 50K. It is now enhanced to 75K. Please be careful, right? There is a difference. If you are opting out of the default tax regime 115 BAC, then it is 50,000. But if you are paying the tax under section 115 BAC, then you have to will get this deduction of 75,000. Okay, so it is allowable. Accordingly, 75K is the deduction. So second, third, and your sixth is the correct answer. Is it okay? Now it's again another MCQ. It's already 6:17. We have to close. This is the last MCQ today. But be extra careful. जो amended provisions and 75K was the amended provision where they have enhanced, they have changed their slab rates, right? और आपका family pension के case में the amount of 25,000 is applicable in case of 115 BAC. Some other provisions are also beneficial in case if you're paying the tax under section BAC, right? They want to promote the people to come forward and take the default tax regime instead of going into, claiming certain deductions, because there are certain reasons that they cannot verify those deductions and all. You have to go for the scrutiny of certain documents and all. So the government is promoting towards the BAC. And this third question, it is on tonnage tax scheme. Of course, you have not, I think, Prerna, have you covered this tonnage tax scheme in some brief?
No, ma'am. In the revision session, I haven't covered, but
Okay.
Yeah, in the regular
In
ones, we
detailed
have
one you
touched.
have covered. Okay,
Yeah.
okay, no issues, because it's not possible in the revisionary sessions. These are
Yeah.
tonnage tax scheme. And one of the question on tonnage tax scheme was there in our May 25 RTP, because it was on IFSC. There we have touched upon an MCQ on IFSC that you can go through. Now you read this question and answer me. There are two tonnage companies, ठीक है, X and Y Limited are amalgamated to form a new tonnage company, Z Limited, a qualifying company which is eligible to claim this tonnage tax benefits. An option for tax scheme of X Limited has an unexpired period of 8 years, whereas in case of Y Limited there is an unexpired period of 6 years. For what period the special provisions of chapter 12G relating to taxation of income shipping companies would apply to the new company Z Limited. The new company is forming after amalgamation, right? So what is the period? It may be a little tricky, but if you go through your study material, you find an example also on that. It's very simple. No, you need not to do any computation. Of course, you have to remember the provision. It's purely on the provision. Yeah, Siddharth, you are right. It's 8 years. Why? Because the provision says ki what will be the longest unexpired period that would be applicable in case of amalgamation. You go through your study material and see it. One of the example is also given, right? You see it, then you will find which provision is applicable on that. It is right. It is 8 years, right? Yeah, higher of the period of the transferred company. Yes, you are right. So that's all for the MCQs, right? And we can now move to our handing over to the Prerna Pasuri ma'am, and she will be taking you through the session, right? Thank you so much. Anything you want to discuss, you can write a mail to us, and you can give your suggestion to the Prerna ma'am. She is here with you for these 3 hours, right? So you please continue. Thank you so much.
Thank you, ma'am. So let's start with our next topic of provision, which is the taxation of the trust. Now, here, we have different kind of trust which are getting covered. So we'll talk about it one by one, in terms of, what are the different kind of trust, and then how is their taxability. So the first one which we will talk about is the securitization trust. Now, what is securitization trust? Any idea? Yes, what is securitization trust? Yes, any idea what is it? So see, securitization trust are basically the trust which, on the security of the assets. Basically, give the funding to the banks. So banks, give the loan to the borrowers and then they give the loans on the basis of some security of assets. Now the bank this amount by giving or pledging the assets to the securitization trust. Now, securitization trust, which is there, it is considered as a pass. Any idea what do we understand by a pass-through entity? What is a pass-through entity? Yes. What is a pass-through entity? See, if the trust which is there, right, is it a person, first of all, under the Income Tax Act, any kind of trust? Is it a person? Is trust a person under the Income Tax Act? What is the definition of person, student? Yes. Income will be taxable in the hands of unit holders. That's right. Yes, Siddharth. So, the securitization trust which is there, this is a pass-through entity. That means the income will not be taxed in its own hands, but in the hands of the unit holder or the investor. Are we getting this particular point? So, the trust, any kind of trust is not a person, right? Now, in the case of the securitization trust, the income is exempt in the hands of the trust under 1023DA, which means that the income will be taxable in the hands of the investors. So, income from the securitization trust will be taxable in the hands of the investors or unit holders in the same manner as if the investor has directly invested in the underlying assets. What does that mean? So let's say if the income of the securitization trust is 10 lakh, now it can be 10 lakh depending on under which head this is earned, right? So let's say under PGBP it is 2 lakh, IFHP is 6 lakh, IFOS is 2 lakh. Now, in the hands of the investor also, the nature and characterization of income will remain the same. So, it will be taxed in the hands of the investor in the same nature and in the same proportion as if it was directly received by the investor only. Right? Now, when the securitization trust will pay the amount to the investors, it has to deduct the TDS under 194 LBA. If the investor is resident, individual and HUF, 25%. In case of others, it is 30%. In case of non-resident, it is at the rates in force. Rates in force means rate under the Act or under the treaty, whichever is beneficial. Right? So, this is about the securitization trust. This is very, very important to understand that, all the trust that you will do it so far will be considered as the pass-through entities, right? That the income will not be taxed in their own hands, but in the hands of the investor. Of course, there'll be some exception that we'll see. Next is the AIF, Alternate Investment Funds. Now, this AIF is what? What are AIFs? Any idea? Yes. What are AIFs? Investment funds. What are these? Regulated by SEBI, that's fine. They invest in startups, okay? Yes. So see, the AIFs which are there, students, these are the investment funds, right? Now, there are different categories of the AIFs which are there, right? Now, they invest in different classes of the asset, right? So, they invest in startups also. They are basically the incorporated in the form of trust or company or LLP, and they are granted the registration certificate from the SEBI, right? And they invest in different asset classes. So we have category 1 and category 2 AIFs which are present. These are the fund managers, the investment funds, right? Now, how does the taxability happens? So in case of the income from PGBP, the profit and gains from business of profession, the taxability is in the hands of AIF. So whatever income which is under the head PGBP is earned, that will be taxable in the hands of AIF. It will not be considered as pass-through. In the hands of the investors, since this is tax in the hands of AIF, in the hands of the investor, this will be exempt under 1023FBB. Now, in the hands of the AIF, if AIF is a company, AIF is incorporated as a company, it will be taxed at the rate of 30, 25, 22, whatever percentage is there. Of course, not 15, because 15 is for the manufacturing companies, right? AIFs are not manufacturing company. If it is incorporated as LLP, then 30%. If it is AOP, BOI, or a trust, then it will be at the MMR. Now, if the income is other than PGBP, then it will be considered as pass-through. So it will not be taxable in the hands of AIF. This will be taxable in the hands of the investors in the same nature and proportion as if directly received by the investor. And when the AIF pay the other income, there will be TDS under 194 LBB. In case of the resident, it will be 10%. In case of non-resident, at the rates in force. Now, with respect to the losses on the AIF, so losses are allowed to be carried forward and set off by the AIF if the losses are under the head PGBP. That is, if there are business losses. The losses will not be allowed to the investors because the income is getting taxed in the hands of AIF. So even the losses will be allowed to be carried forward and set off by the AIF. For the other than PGBP losses, the condition is that the investors will be allowed to set off and carry forward the losses, but the units should have been held by the investors for greater than equal to 12 months. If the units have been held for less than 12 months, losses cannot be carried forward and set off by the investor. Let's solve one question in relation to this from the module itself. Yep. So you have the particulars of the four investment fund, A, B, C, D, business income, cap gain, IFOS is given. You are required to compute the total income of the investment fund and each unit holder, assuming that each investment fund has 20 unit holders having one unit held by them for a period exceeding 24 months. And income from investment in the investment fund is the of the unit holder. If the investment funds following components for AY 26-27, what would be the total income of the fund and the unit holder for that year? So this is the next part of the question. The first part is this. So first tell me about the AIF 1, AIF A, which is there. Yes, first tell me about AIF A. What would be its taxability? Yes. Yes. Fully taxable in the hands of unit holder, Siddharth. Yes, this will be fully taxable in the hands of the unit holder, right? Because this 20 which is there is income from the head, capital gain and other sources. So in the same proportion, so this 16 divided by 28 and 4 divided by 22 will be taxable in the hands of the each unit holder. Are we clear? So it will be taxable under these heads only in the hands of unit holder. In under the head capital gain 8 and under the income from other sources 2. Right? What about the fund B? Yes.
Ma'am, I could not follow that proportion. That 16 by
I'll explain.
20.
See, as I told you that it will be taxable in the hands of the investor in the same proportion and the characterization would remain the same as in IF. So the capital gains would be 80,000. Income from other sources would be 20,000 because each is holding 20 shares. Is holding the 20 unit holders have 1 unit. So there are 20 unit holders. So 16 divided by 20 and 4 divided by 20. And this is rupees in lakh. Are we clear? Yes.
Yeah, clear, ma'am.
Business income, yes, taxable in the hands of the AIF, capital gain and EFOS taxable in the hands of the unit holder. So 14 divided by 2 and 4 divided by 2. So 14 divided by 2, 7 under capital gain and 2 under income from other sources. What would be the tax rate in the hands of the AIF for that 2 lakh? Okay, Akshay. Yes, what would be the tax rate? Yes. MMRT. Why, Siddharth, it would be MMRT? Yes, why it will be MMRT? Yes, what would be the tax rate? Yes, please. Why it would be MMR? It's a company or LLP? Okay, you thought it's not, so you have to make an assumption. If it is company or LLP, as I said, 22, 25 or 30. LLP 30 and if other, then only MMR. Fine. Now what about the fund C? Yes. Losses of 2 lakh will be covered by AIF, 8 lakh income taxed, and 6 lakh carried forward in the hands of the unit holder. So see, 2 lakh will be carried forward by the by the investment fund, the AIF. The 6 lakh which is there will be, can we set it off against the 8 lakh? Yes. No, right? But even for this 2 lakh, can this be set off against the 8 lakh? Can this business loss of 2 lakh be set off against the 8 lakh? Yes. So see, before you distribute unit holder, you will first set off this 2 against this 8. So technically, this 2 will not be any more present. So what you will distribute to the unit holder is only 6 under the head income from other sources, right? This 6 can be carried forward by the unit holder because this can't be set off against any other head of income. So in the hands of the fund C, nil, they will not carry forward a set of any losses. In the hands of the unit holder, this will be 30,000. 6 lakh divided by 30. 6 lakh divided by 20. Are we clear? Yes. Last one, D. What will happen in the case of D? 5 minus 2 will be taxable in the hands of AIF. That's right. Yes. So 5 minus this 2 other sources will get set off, and then you will have this 20. This 20, this, against this 20, yes. Will this be taxable in the hands of the unit holder? Answer is yes. This will be taxable in the hands of the unit holder, which will be 20 divided by 2, which will be 1 lakh each. 20 divided by 20, sorry, will be 1 lakh each. Right? Yes or no? Next part is, if the investment fund C has the following income components, what would be the total income of the fund and the unit holder for that year? So this is, we are talking about the next year. Now for this fund C, if next year there is a business income and IFOS of 8 lakh, how will the taxability work? Yes, Akshay, before distribution, they'll be set off and then distributed. That's absolutely correct. Because what will remain only can get distributed. What will happen to the next year? Sure, I can change the cursor.
Recording in progress.
Any questions? Any questions?
Recording in progress.
Next is the REIT or InVit. Now, what are the REITs? What are the REITs? Real Estate Investment Trust. Now, these are again incorporated. The units of the REITs are listed. These are incorporated as trust and they make the underlying investment in the immovable property. Are we clear? So, how does a REIT function is? Usually, the REITs take the special purpose vehicle. What is a special purpose vehicle? Special purpose vehicle means a company, right, which will be used as an intermediate company to make the investments in immovable property. So either REIT can directly make an investment in immovable property or it can make the investment through the special purpose vehicle. Now, in case it chooses to invest through the special purpose vehicle, in that particular case, let's say there is an already existing company which is there. Now, the REIT wants to acquire the shares of that company. So, from whom it will acquire? From the shareholder of that company, right? So, from the shareholder of that company, the shareholder of that SPV will transfer the shares of the SPV, that will transfer the shares of the right? And the REIT will then give the units of the REIT to the shareholder in exchange, right? So the shareholders of the SPV are giving the shares to the REIT and the REIT will issue the units to the shareholder in return, right? Now, if the shareholders are giving the shares of the company to the REIT and the REIT is giving the units to the shareholder, this is a transfer which is taking place from the shareholders to the REIT because the shareholders' rights in the shares of the company are getting extinguished, isn't it? But there is a specific exemption for there under 47. Section 47 says that this transfer of shares of the SPV by the shareholder to the REIT, this is not considered as a transfer under 47. This point clear and this point clear? Okay. Now, if the shareholders is a company, if the shareholder of a SPV is also a company, right? Then if a company is there, what gets applicable to a company? Minimum alternate tax, right? If a shareholder was a company, there is an applicability of MAT on the company. I'm talking not about the SPV. I'm talking about the shareholder who is also a company, right? Now, when the one company transfers the shares of another company, right, in exchange of the units of REIT, as per the accounting standards, it will recognize in the books of accounts notional gain or loss on the transfer of shares in exchange of the units of REIT. Yes or no? Now, if in the books of accounts they recognize the notional gain or loss, MAT will be applicable on that because MAT is on the net profit as per the P&L account, right? So under the MAT, there is a specific adjustment for this. It says the notional gain or loss has to be reduced or added back from the book profit calculation. And the actual gain or loss should be added. Are we getting this particular point? So, the notional gain or loss has to be reduced from the book profit for the purposes of the MAT calculation. When the units of the REIT are actually sold, gain or loss should be added at that point to the book profits. So when the units of the REIT will get sold, at that point, you will recognize the actual gain or loss. When the shares of the SPV are being transferred to the REIT, at that time, any notional gain or loss should not be included in the book profit. If it is included in the book profit, excluded. So this is a specified adjustment. Clear this particular point? Yes. Now, when the units are sold by the shareholders, so shareholders transferred their shares in SPV, got the units of REIT. Now, when these shareholders will sell the units of the REIT, there will be capital gain at that point. So, this actual gain or loss should be included in the book profit if it is not already included. Now, for the purposes of the capital gain, what will be the period of holding of the units of the REIT? Since this is not regarded as a transfer, the transfer of shares of SPV against the units of REIT was not regarded as transfer under 47. For the purposes of the period of holding under 242A, the period of holding of the units will include the period of holding of the shares also. So, since these units are received in exchange of the shares of SPV, the units period of holding will include the period of holding of shares. Now, before 23rd July 2024, the period of holding of the units of REIT was 36 months. If it is more than 36 months, it will be long term. Now, it is considered as 12 months after 23rd July 2024 for the purpose of determining whether it is long term or short term. Now, if it is short-term capital gain, there will be tax under 111A because the units of the REIT are listed, and under 111A, before 23rd July, the tax rate was 15%. After 23rd July, it will be 20%. If it is LTCG, under 1128, it will get covered. And if it is before 23rd July, it will be 10% above 1.25 lakh. And after 23rd July, it will be 12.5% over and above 1.25 lakh. What will be the cost of the units of REIT? It will be the cost of the shares of the SPV. Are we clear up till this point? Yes or no? Yes? Okay. Now, coming to the taxability of the income of the REIT, right? Now, again, the REIT is considered as the pass-through entity. Now, if the REIT invests through the SPV into the immobile property, what kind of income the REIT can expect? It can receive the dividend from the SPV. SPV is a company. The SPV will earn the immobile property income and it will distribute the dividends to the REIT. Now, what will be the taxability of the dividend? In the hands of the REIT, the dividend received from the SPV will be exempt under 1023 FC. Also, when the SPV distributes the dividend to the REIT, it is not required to deduct the TDS under 194. Are we clear? Because this is the exempt income. Whether this will be taxable in the hands of the unit holder, it depends on the question that whether the SPV has exercised the option under 115BAA, which means if the SPV exercises the concessional tax rate of 22%, then the dividend will be taxable in the hands of the unit holder. If the SPV is not exercising the concessional tax rate of 22%, dividend will also not be taxable in the hands of the unit holder. And the REIT, when it will distribute this income to the unit holder, there will also not be TDS. In case the SPV has exercised the option under 115BAA, then the dividend will be taxable only then in the hands of unit holder. And in that case, the tax rate, if it's a resident unit holder, it will be normal rate. If it is non-resident, it will be 10% or 20% under 115A. Are we clear? And the TDS will be 194, and the 194 will be 10% for resident, 10% for non-resident. Clear? Now, if the REIT is receiving the interest from the SPV on any loan given, right? In that particular case, what will be the taxability of the interest? So, if the SPV gives the interest to the REIT, this will not be taxable in the hands of the REIT under 1023 FC. SPV is therefore not required to even deduct the TDS under 194A. This income will be taxable in the hands of the unit holder. If it is resident at normal rate, there will be TDS under 194 LB at 10%. If it is non-resident, then it will be taxable at 5% and TDS also 5%. Right? If the REIT directly earns the income from the immobile property, right? Then in that particular case, this rental income will also be exempt in the hands of the REIT under 1023 FCA. And therefore, there will also not be any TDS which will be deducted by the tenant under 194I. This will be taxable in the hands of 194 LBA. For resident, it will be 10%. For non-resident, at the rates in force. Now, how will you characterize this income? Under what head will this income be characterized? If it is commercial house property, then it will be taxable under the head IFHP, even if this is the business of REIT to give the immobile properties on rent because of the specific amendment by way of explanation 3 to section 28. If it is a commercial property, rental from commercial property, then only it will be considered under the head PGBP, since it is the business of the REIT to invest in house property and generate rental income. And there you'll apply the ratio of the Chennai property case. Now, if the REIT has the capital gain taxable in the hands of the REIT, LTCG under 112, STCG under 111A, and others at the rate of the MMR. And in the hands of the will be exempt. Are we clear? Yes or no? Any questions till now? Okay. Any distribution by the REIT is made to the unit holder, which is in the nature of repayment of debt or redemption of the units, then this will be taxable under the head income from other sources under 56(2)(12). Now, this should be in the nature of repayment of debt or redemption of units. So, it should be distribution of any sum other than dividend, interest, rental income, because this is taxable in the hands of unit holder already, or any sum which is chargeable in the hands of the business trust. So anything which is already taxed in the hands of business trust will be exempt in the hands of unit holder. So this is over and above if any sum is paid to the unit holder, we are talking about the taxability of that. So what is the tax amount? It is the aggregate of all the distributions made by the business trust to the unit holder during this year or earlier year, minus the cost of the units of the business trust. Right? Minus any amount already taxed in earlier previous year. So let's say, for example, in this particular year, I have made these distributions in financial year 21-22 10, in 22-23 12, and in 23-24 100. So my A will be total of all the distributions other than which are in the nature of dividend, interest, rental income, or any amount which is already taxed in the hands of business trust. From this, use the cost of the business trust, let's say it is 10, and any amount which has has already been taxed in the earlier year. Right? So if already taxed in the earlier year is, let's say, 122, so this will get reduced. So for this year, only 10 will get taxable. Are we clear? And if, let's say, for example, my cost of unit is higher than the amount received, which means if there is a loss which is happening, then if A minus B minus C is loss, then 56,212 will be considered as 0. Are we clear? And in the case where the cost of acquisition of the unit of the business trust for the unit holder, if it is there, from that amount, in that, if it is a loss situation, then in the case when I have the cost of the units which I am considering, from that amount under the capital gain, I will reduce any sum which is received by the unit holder from the business trust, which is not in the nature of the interest, dividend, rental, or any other income which is taxable under the 56,212 or in the hands of the REIT. Now, what does this mean is that to the extent of the cost of units, I have to reduce the distributions from the cost of unit. And there will be therefore no tax under 56,212. But if I receive more than the cost of units, this will get taxed under 56,212. Okay. So let's say, for example, if my cost of unit is 1,000 and distribution by REIT is 1,500, and let's say out of 1,500, 500 is interest, 200 is STCG, 100 is other income. Now this 500 is taxable in the hands of unit holder, 200 gets taxed in the hands of REIT, STCG, 100 gets taxed in the hands of REIT, right? Now, what therefore remains is 700, right? Now 700 is basically lesser than the cost of the unit. So what will happen is when I will sell my units in the market, at that time from the cost, I will reduce this 700 and 56,212 will be 0. So from this 1,000, I will reduce 700 and my cost will only be 300. But if, let's say, for example, my distribution is 2,000. Now, out of 2,000, again, if I reduce 800, my distribution remains now 1,600. Now, this is more than 1,000, right? So, this 1,200 minus 1,000, 200 will get taxed under 56,212 and nothing has to be reduced from the cost of asset. I hope this is clear to everyone. Yes or no? Yes? Okay. So let's solve one question. A business trust registered under SEBI gives particular income for 24-25. Interest income from Beta 4 crores. Now, Beta is an Indian company in which the business trust holds 70% of the shareholding. What will be the taxability of this interest? This is taxable in the hands of the unit holder. There will be no tax liability in the hands of business trust due to 1023 FC pass-through exemption. Therefore, Beta will also not be required to deduct TDS and this will be taxable in the hands of the unit holder, isn't it? Now, the business trust will have to deduct the TDS 10% if it's resident unit holder, 5% in case of others, right? What about the dividend income? 2 crores. Yes. Since the SPV has opted out, so here they have given that the business trust has distributed 10 crores to the unit holder. Assume that beta does not opt to pay tax under 115 BAA. So this will be exempt in the hands of the trust, exempt in the hands of the unit holder also, because the beta has opted out of 115 BAA. Very good. Short-term capital gain on sale of listed shares of beta transferred on 1/9/20. Yes. This will be capital gain, short-term capital gain on sale of the listed shares. Yes, it will be taxable at 20% because this is after 23rd July under 111A. Are we clear? Yes, and this would be exempt in the hands of the unit holder. Short-term capital gain on sale of developmental properties. Yes. Taxable under 112. This is short term, not long term. This is short term on sale of developmental properties.
MMR rate.
MMR, because for this there is not which is given. Are we clear? Okay. And in the hands of the unit holder, this will remain as exempt. Interest received from investments in unlisted debentures of the real estate companies.
Ma'am, in case of developmental properties, the STCG, that has to that doesn't get covered in the specific list of rates. That's the reason it is taxed at MMR, is it?
Yes, yes.
Okay. Okay, thank you.
What about the interest on the unlisted debentures?
This is also MMR rate.
Correct. This will also be MMR and there will be no taxability in the hands of the unit holder. Rental income from the real estate assets.
Exempt in the hands of REIT.
Yes. This will be taxable in the hands of unit holder. Also, there will be no TDS on REIT under 194I. So you have to mention in exam even about the TDS provisions as well, right? When you write. But the REIT will deduct the TDS when it makes the payment to the unit holder. Now, unit holder gets taxed at the in the proportion of this. They have distributed 10 crores. So 10 into 4 divided by 11 will be taxable as interest. 10 into 2.5 divided by 11 will be taxed as rental income. This They have not given any information that whether this is commercial or residential. So you will make an assumption, or you will just write in the note that if it is commercial, it will be taxable under the head PGBP. If it is residential, this will be taxable under the head IFHP, basis the explanation 3 inserted to section 28. Are we clear? Yes? Any questions? Any doubt? Right? Okay. Let us then move to the next part, charitable trust. Now, under charitable trust, there are two regimes, students, 1023C and section 11 to 13, which is the second regime. 1023C has certain specific trusts which are exempt irrespective of any conditions, right? There are no conditions attached. They are exempt as is. Like, these Gandhi Trust or Nehru Trust. There are many, listed examples, right? So those are specific. Second are the educational institutions existing solely for educational purposes and not for profits, which are wholly or substantially financed by government. Now, what are the educational institutions existing solely for the educational purpose? What do we mean by solely? So, Supreme Court in New Noble Educational Society had interpreted this term solely. That solely means that exclusively. It doesn't mean predominantly. So it shouldn't be the case that the trust is engaged majorly in educational work and some other ancillary activity. It will not qualify as existing solely for educational purpose. Solely for educational means exclusively on the educational service. The question arises, therefore the trust cannot provide any ancillary services. So the Supreme Court has said that if the objective of the institution is to earn the profits, 1023C is not available. It is not existing solely for educational and not for profit. However, there is no bar in generating the surplus from the course of providing education. See, there can be surplus, but their objective should not be to earn profit. So even if I earn certain surplus, let's say my fees are more than my expenditure, but this surplus also should I utilize for educational facility. Let's say, for example, for building library, for building a shop for textbooks, right? And if I earn some incidental activities which are related to the educational, for example, if I sell textbooks in the school, if I provide or earn income from the bus facilities that I'm operating, hostel facility that I'm operating, so I am earning some incidental income. It doesn't mean that therefore I'm not operating solely for education. I'm still operating solely for educational, but these should be incidental activities should be related to education. And I should maintain a separate books of accounts for incidental activities. Right? If that be the case, it will still be characterized as existing solely for educational purpose and not for profit. However, if the institution provides the facilities not to the students but to outsiders, for example, renting of the one hall in my school to marriage function, for a marriage function, this is not incidental to the objective of education, then I will not qualify for 1023. So, educational institution existing solely for educational purpose means it should be exclusively for education and not for profit. And it should be wholly or substantially financed by government, means the government grants should be more than or equal to 50% of the total receipts. Are we clear? Again, in St. Peter's Educational Society, Supreme Court has held that educational does not mean a formal educational institution. It can be even the diploma courses, certificate courses that will also be eligible for 1023. Are we clear? These institutions again does not have any other condition other than existing solely for educational and wholly or substantially financed by government. Clear? They don't need to obtain any registration certificate from the commissioner. Specific trust, educational institution which are existing solely for educational, they don't need to obtain any registration certificate. Clear? Then hospitals which are wholly or substantially financed by the government, they have these unconditional exemption. Third is the institute universities existing solely for education or medical institutions or hospitals, if they are not financed by the government, if they are not wholly or substantially financed by government, then the condition for them is that their annual receipt should be less than 5 crore. This annual receipt condition is combined combined threshold for both educational institution as well as hospital. So let's say if I'm running a hospital as well as a medical college, then the combined receipts of both should not cross 5 crore. Are we clear? Again, here there is an unconditional exemption, meaning you don't need to obtain any registration. Finally, the last one is the charitable, religious institution, medical institution whose annual receipts are more than 5 crore, educational institutions whose annual receipts are more than 5 crore, they can get the exemption under 1023C provided they obtain the approval from the commissioner. And the approval can only be applied before 1st October 2024. So if the application was filed before 1st October 2024, only then these category D will be covered under 1023C. Because post 1st October 2024, now the applications for the exemption by this trust can only be made under the second regime. For those, the 1023C will not apply. So post 1st October 2024, only these A, B, C category of trust can claim the exemption under 1023C, and D if they have already made an application before 1st October 24. Are we clear? Therefore, coming to the second regime. The second regime says that income from property held under trust wholly for charitable or religious purposes will be exempt under 11. Now, what is charitable purpose? That is defined in the 215. It says relief of poor, education, yoga, medical relief, preservation of environment, preservation of monuments, advancement of any other object of general public utility. If the activities are carried out in the nature of trade, commerce, business, cess or fee, irrespective of how I am applying the money from such trade commerce, even if I do a business and apply the business income for, let's say, charitable purpose. Let's say I earn the business income and I apply that business income for the poor. Will it make it a charitable purpose? Answer is no. It will not be regarded as advancement of any object of general public utility. Right? Means that I am doing the activities not in the commerce or business. If the activities are undertaken in the advancement of the object of general public utility, and I have certain income from the trade, commerce or business which is kind of incidental, and the receipts from that business income should be less than 20% of the total receipts of the trust, then only it will be considered as advancement of any other object of general public utility. Right? If the income is from the, if the particularly I am doing the activities A to F, then there is no condition of this 20%. Even if in that case my trading activity receipts are more than 20% of my total receipts, activities will still be charitable. This 20% condition is only with respect to advancement of any other object of general public utility. So if I'm not covered under A to F and I'm doing the trade, commerce or business, then my trade, commerce or business receipts should be less than 20% of total receipts. If I'm engaged in the object of, let's say, education, and I'm doing the trade also along with that, my trade receipts are more than 20% of total receipts, in that case, I would still be available for the exemption under 11. The Supreme Court in Ahmedabad Urban Development had held that you have to identify whether the markup on the cost is nominal or significant. If it is significant, then only you test the exceptions that whether the trade, commerce or business is more than 20% of total receipt. If it is, nominal markup, then it may show that these activities are incidental to the main object of general public utility. Then they are not in the nature of trade, commerce or business. For example, sale of textbooks. For example, as I said, that, if I'm doing any particular, let's say I am providing the services for, let's say, pets or the stray dogs, not pets, the stray dogs, right? Now, this can be advancement of any other object of general public utility. Now, let's say I am, doing some incidental activities. Then it will not fall under trade, commerce, or business. If my markup on those activities is high, then only we have to test whether the receipts from those activities are more than 20% of total business. Clear? Any question, any doubt? Yes? Fine? Okay. So let us take here a short break of 10 minutes before we get into the statement of total income, and then we will start again. Let's take a break of 10 minutes. Students, we are discussing about the computation of the total income. Okay. So we start with the gross receipts. Okay. So income derived from the property held for the charitable or religious purposes in India, right? So here you have to start with the gross receipts. So even if it says income derived from property, here we mean is gross receipts and not the receipts minus expenditure. Then we have the voluntary contributions, right? It will be including other than the corpus donation. Whatever voluntary contribution you receive other than the corpus donation are to be considered as a part of income. Now, corpus donation are not income if they are deposited in the mode specified under section 11(5), or if they are received for repair or renovation of the religious trust. They will not be considered as income if the amounts are utilized for the purpose for which the contribution was made. Amounts are not utilized for making the contribution or donation to any other trust, or the amounts are invested in the mode specified in 11(5). If these conditions are violated, then it will be deemed income in the previous year of violation. Are we clear? Income from government grants or securities is also your income. Anonymous donation. Now 5% of total donation or rupees 1 lakh, whichever is higher, right? That's the limit that you consider for the purposes of section 115 BBC. Beyond this limit, beyond this specified exemption, the anonymous donation will get taxed at 30%. Now this 5% of total donation will include the voluntary, anonymous and even the corpus. You will not exclude the corpus from this, right? Now 115 BBC will not be applicable where the trusts are created wholly for the religious purposes. In case of the trusts which are established for partly religious, partly charitable purposes, 115 BBC will apply only if donations are received. That donations will be applied to the educational institutions or hospitals. Are we clear? And in any other case, 115 BBC is not applicable. Clear? In case of charitable trust, for the corpus donations which are received as the anonymous donation, even on that 115 BBC will be applicable. So even if they are corpus, but if they are the anonymous in the nature, then 115 BBC applicable. Next nature of income is capital gain. So capital gain will be a sale consideration minus cost of acquisition. This will give you the gross total receipts. You will take 15% of your gross total receipts as the ad hoc application. Then balance 85% you have to apply for the charitable purposes, right? One can be for operational expenditure. Now expenditure is allowed as the application only when it is actually paid irrespective of the method of accounting. So expenditure incurred but not paid during the year will not be allowed. Expenditure on which TDS is deductible but not deducted, or deducted but not paid till the due date of 139(1), 30% of expenditure gets disallowed. Expenditure in cash more than 10,000 not allowed as application. Capital asset acquired is again allowed as the application, but depreciation on the capital asset is not allowed. Application from loan considered as application of income in the previous year of repayment of loan. So when you take the loan and let's say incur some expenditure out of that, that is not considered as application. When you repay the loan, that will be considered as the application. Now application from that loan should be in India, should not be for the corpus donation to another trust. Any application for the expenditure should be after TDS deduction. Application should not be for cash expense more than 10,000. Application should not be for a person who is referred to in section 13(3). Repayment of loan should be made within 5 years from the previous year in which application was made for the loan. So let's say for example, if 13 lakh is loan amount and if 5 lakh is applied for building, then in the year, let's say March 25, 2 lakh is repaid. So 2 lakh will be considered as application and not 5 lakh. Clear? Then application from corpus donation will be considered as application of income in the previous year in which amount is deposited back in the mode specified under section 11(5). So any application from the corpus donation is not considered as application. So let's say for example, if you receive 10 lakh as voluntary contribution with a specific direction that it will form part of the corpus of trust, that is exempt. Now 2 lakh when you apply for construction of building, this is not application. When you put 1.5 lakh back to the mode specified in 11.5, this will be considered as application of income. Donation to any other trust registered under 12AB or 1023C, irrespective of the objective of the trust. So if you make a donation to another trust, only 85% of the donation shall be considered as application of income. And any amount paid towards the corpus of other trust or any amount paid from the accumulated amount to the trust will not be considered as the application of income. Are we getting it? Yes. Then, if let's say for example, now the trust is not able to apply the income as the income is accrued but not received during the previous year, or income is received late during the previous year, right? Then there is an option available to the trust under 12AB. It is not available under 1023C for the deemed application. The condition is that the income should be applied in the previous year of receipt or in the next following previous year, right? So if the income is accrued but not received, then the income should be applied in the previous year of receipt or in the next following previous year. It will be considered as deemed application in the current year. If I do not apply in the next previous year, then or in the following previous year, then it will be considered as deemed income of that particular year. Are we clear? Or if the income is received late during the previous year, then again I have the option to consider this by filing form 9A, that this will be considered as the income of the this should be considered as deemed application if the income is received on the last day of the previous year. Then if it was not applied in the next year, it will be considered as deemed income of the next year, right? So the option is to be exercised by filing form 9A 2 months prior to the due date of return of income. But the CBDT has given the extension that this file can be formed even by the due date under 139 month, even if it is not filed prior to 2 months, right? Now, if the trust is not able to apply the income and also accumulate in the mode specified in 11.5, this can also be considered as deemed application of income if the trust files form 10 by stating in form 10 the period for which it wants to accumulate the income and the purpose for which it wants to. This form again needs to be filed 2 months prior to the due date of 139.1, but the CBDT has extended it that it can be filed by the due date of return also, right? Now, I can then therefore, accumulate the amount. Now, if I fail to satisfy the conditions of accumulation, that is if I have accumulated the income but income is applied for other than charitable or religious purpose, then it will be considered as deemed income of the previous year in which income is applied for other than charitable or religious purpose. If the amount of income ceases to be accumulated, then it will be considered as deemed income of previous year in which income ceased to be accumulated. If the income ceased to remain invested in modes 11.5, then it will be considered as deemed income of previous year in which it ceased to remain invested. If the amount is not utilized for the purpose for which it is accumulated, then in the last of the 5 years, it will be considered as deemed income of that year. If the accumulated amount is paid to any other trust, then it will be considered as income of the previous year in which it is paid or credited to the trust. Clear? Now, application in respect of the capital gain. So, if there is a capital gain which is there, now how will you apply against that? So, if the entire sale consideration is utilized for acquiring new asset, entire capital gain is deemed to be applied. Where part of the sale consideration is utilized for acquiring new asset, then the application will be cost of new asset minus the cost of the old asset, right? Now, there is another income which is considered as specified income or deemed income under 115 BBI. What it says is that if the income is applied for the benefit of prohibited person. Now, who are the prohibited person? So, the prohibited persons are author of the trust, contributor to the trust if the contributions are more than 50,000, if the author is HUF, any member of the HUF, relative of the author or trustee, any trustee of the trust, any concern in which 1 to 5 have substantial interest, that is more than 20% of voting power or 20% of profit share. So if the income is applied for these prohibited person or income in excess of 15% is accumulated where accumulation is not allowed, that is if I have not filed the form 10 on time, or income not received during the previous year but it should have been applied in the next year or the following next year, and if this income is not applied or if the income is received late and it is not applied in the next year, or if the income is accumulated and it is not applied for charitable or religious purpose, it ceased to be invested in 11.5, it ceased to be accumulated, or it is paid to any other trust, or not utilized for the specified purposes within time, or it is applied for charitable purposes outside India. In this case, the income will be taxable at 30% on gross basis without any deduction or expenditure. Are we clear? Yes. So if I'm making the payment to another trust for the corpus of that trust, it will not be considered as an application. If I am giving to another trust from the accumulated amount, then it is not considered as again application. If the rest of the income I am giving, then 85% of the amount donated is only considered as application. Are we clear about this? Yes or no? Any questions, any doubt? Okay. Method of accounting, if I follow the cash basis, the income is recognized on receipt, the expense is recognized on payment. If I am following accrual basis, income will be recognized on accrual. So therefore, income which is accrued but not received, we can consider the deemed application by filing Form 9A, and we can apply in the next year or the following year. And the expense, even if I follow the accrual method, I will still recognize the expense on payment basis. Now, denial of the exemption. The exemption of the trust will get denied if the income held under the trust is for the private religious purpose or for any benefit of any particular religious community or caste. If the income is applied for the benefit of the prohibited or specified person. Now, this will be taxable in the hands of the trust. Exemption under 11 will be denied. There will be specified income tax at 30% on gross basis. There will also be a penalty under 271 AAE. For the first time offense, 100% of income applied. For second time, 200% of income applied. In the hands of the specified person, there will be 56 to 10, which will get applicable. If I deposit the funds in modes other than 11.5, it will be resulting in denial of exemption. This is not applicable to the funds from the business. However, if the trust has charitable plus incidental business income and it maintains a separate books of accounts, then it will be applicable. If I have anonymous donations greater than 5% of total donation or more than 1 lakh, or the anonymous donation forming part of the corpus of the trust, it can result in the denial of exemption only with respect to the anonymous donation. Trust having the object of general public utility, having receipts from business greater than 20% of total receipts. Form 10 is not furnished within the due date of return of income or return of income is not filed. It will result in denial of the exemption. Are we clear? Shall we solve one question in relation to this? Yes? Let me share the question. So, Public Charitable Trust registered under 12AB runs a hospital and a medical college. It furnishes you the following information for the year ended 31st March 25. Gross receipt from hospital rupees 425 lakh, including the voluntary contribution towards the corpus. The third point, if you read, voluntary contribution received from public is 32 lakh. It includes the corpus donation of 3 lakh from another charitable trust and the anonymous donation of 5 lakh. Note, voluntary contributions are included in gross receipts given in 1 above. How will you treat this? Yes. What will be the taxability of this? Yes, students. Yes, this very simple one. Yes,
We have to take 29 lakhs, ma'am.
29. How 29? Corpus donation would be exempted, voluntary contribution would be included. Yes. So we will consider the entire 425 lakh, which will include the voluntary contribution also. And from that, you will just exclude this. Sorry. You will exclude this 3 lakh. So this corpus donation, which is there, this will not be included. Right? So if I have to write it, my gross receipts will be 425 minus 5 lakh. Are we clear? Sorry, 425 minus 3, not 5. 422. Okay. Yes, is this clear? Income from business incidental to the main object, rupees 2 lakh.
We have to include it.
Yes, you have to include it, right? So, income from business. Here, do we check the condition of 20% students? Do you check the condition that whether it exceeds 20% of your total receipts or not? Yes, we will talk about anonymous also, Siddharth. Wait for it. What about this 20% condition here?
No, it's not. We have to not.
Why?
It is not for any other object of general public utility.
Correct. This is not for any other object of general public utility. What is the objective here is? The objective here is basically to run the hospital and educational institution. So medical and education. Will we check the condition of the 20%? As I said, no. If the objective is only when it is in respect of the advancement of any other object of general public utility, at that point you will check that whether this is continuing the more than 20% of the receipts are there or not. Are we getting this particular point? So if you talk about that any other object is there of the trust, in that case, you will not check the 20% condition. That is very, very clear. So do not get confused. Do not even write a note in relation to that in the examination. So only when if the question would have told you that the institution is having the object of general public utility as its main object and its total receipts are this much, out of which the trading receipts is this much or incidental receipts is this much, then you will test that whether receipts from such activity does not exceed 20% of the total receipt, and whether such activity is undertaken in the course of carrying out the advancement of general public utility objective. Are we clear? So if it is any other purpose which is charitable purpose, then these 20% condition will not be applicable. Any question with respect to this? Clear? Fine? Okay. Now, tell me one thing. With respect to this particular amount, this will get included in my income? Yes or no? This will get included in my income. So let's just include this particular amount. So this is income from business. So you can write that in note that this year 20% condition will not be applicable. What was the amount?
2 lakhs.
2 lakhs, right? Voluntary contribution includes 32 lakh. It includes the corpus 3 lakh from another charitable trust and anonymous donation of 5 lakh. Now, what about the anonymous donation? Whether this will be included or not?
Included only 5% of total donation or rupees 1 lakh, whichever is higher.
So this will get included in the contributions itself or in my income itself. But what is, separately covered, on which the application is not allowed, on which the exemption is not allowed, is the anonymous donation in excess of the higher of these amounts. So basically what I will do here is, so less anonymous donation, higher of, what is the amount? 5% of total donation or 1 lakh. Now, what is 5% of total donation coming to? Yes. What is the total donation that you will consider?
Ma'am, question we can't see.
Sorry?
Question which amount?
What is 5% of total donation? What is total donation here?
Here 32 lakhs.
Correct? Here this will include the corpus also. Yes. So 32 lakh is my total donation. So here I will include 5% of 32 lakh or 1 lakh, whichever is higher. What is coming? What is higher amount?
1,60,000.
1,60,000, that's the higher amount. Yes. So 1.6 lakh is what I will reduce from the 5 lakh. Now, since 5 lakh is already added in my gross receipt, sorry, 1.6 is going to be taxed at, will be considered for application. So what is going to be reduced is 5 minus 1.6. Are we getting it? So this is coming to 1.6 and I have received 5, which is included in my gross receipt, minus 1.6 lakh, because 1.6 lakh is eligible for the exemption. The 3.4 lakh is something which I will not allow the exemption because section 13 denies it. Are we getting it? So 422 lakh is already included the anonymous donation. One way, one presentation could have been, you would have reduced 422 minus 5 also. Then from 5, you would reduce 1.6 and offer 3.4 for the purpose, 5, out of which 1.6 only you will put for the application, 3.4 you will any which ways reduce it. So the 3.4 lakh would be subject to tax at the rate of 30% under 115 BAC, because as per section 13, these anonymous donations are not eligible for the application of income. Are we clear? Yes or no? Fine. Yes or no?
Yes, ma'am.
Okay.
But in this corpus, this donation, voluntary donation is 32 lakhs. In that only, it includes only corpus donation, but it is not mentioned that anonymous donation is also included in that or
It is
not.
mentioned now, this amount. It includes the corpus and the anonymous donation of 5 lakh.
Yes, 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 ma'am. Yes, ma'am.
Okay.
Yes. Yeah.
From gross receipt, we have to reduce 8 lakh, that is 3 lakh corpus, 5 lakh. See, Siddharth, that's what I'm saying. That's one way to present. Either from the gross receipt, you reduce 425 minus 3 minus 5. And then treat anonymous separately again as a separate line item. And you show that from 5, I am reducing 3.4 and only 1.6 I am considering over here. What I have done is I have included 5 in 425, and from that I am doing the same treatment of reducing the 3.4. It's the same thing that I am doing, Siddharth. Fine? Okay. Income from, hospital operational expenses incurred 105 lakh. This does not include the capex and depreciation.
Ma'am, this
Treat as
will
application.
reduce. Yeah,
Yes.
but after 15%,
Sorry.
15% statutory limit is there, no? That
Yeah, that is there, but that is after this. So you have to first reduce the operational expenses also. See again, there are two things which you have to consider. You are right. First, whether we apply the 15% or first we reduce the expenses. Now, in respect of this, in your module, right? In your module, there is a judgment which is given, which says that when we consider the receipts or the income by way of the property held under the charitable or religious purposes, we talk about the gross receipts and not the net receipts. So this amount can be reduced only after calculating the 15%. Are we getting it? So this basically there are two viewpoints. One view is that you reduce this amount and then calculate 15%. But what ICAI is following in the module is that first it is allowing 15% and then it is allowing this reduction of the amount. For the reason that the income ICAI considers is the gross receipt and not the net receipts. Right? So the ICAI's viewpoint is that you first consider the gross receipts, reduce the 15%, and then you move to the expenditure which can be allowed or any other application that can be made from that 15%. So this is the Supreme Court ruling in the CIT versus Program for Community Organization. I'll show it in your module as well. See. What they have said it over here is, they have said that here, while calculating this particular amount, see, as per the Supreme Court ruling, in the CIT versus Program for Community Organization, 15% of gross receipts would be eligible for accumulation under Section 11. So they are not saying that 15% of the net amount needs to be considered. Even though the word uses 15% of income, and income means receipt minus expenses, but the ICAI, relying on the Supreme Court ruling, is saying 15% of gross receipts would be eligible for accumulation. Are we clear? So here you are right that first we will reduce the 15%. So here we'll take the total of the receipts, which is 422 plus 2 minus 3.4. 420.6 less 15% ad hoc. $63.09. From this, so here you'll make a reference. CIT versus Program for Community Organization. 15% of the gross receipts. Are we clear? Then you will reduce here the expenses. Now, here what they said is that this is the expense incurred rupees 105 lakh. Now, let's say if I add one more adjustment over here and I tell you that expense of 10 lakh is incurred but not paid during the previous year. It is paid before the due date of 139.1. What will you do with this 10 lakh?
Reduce it from expenses.
Yes, but it is paid before the due date of 139.1 still?
Yeah, ma'am. In trust and institution,
Yeah.
up to whenever we are paying, at that time we have to take.
Correct. So here it doesn't matter. Here this is not similar to section 43B. So in exam, don't get confused. Here we will reduce this 10 lakh, and from this 105 lakh, we will reduce this 10 lakh and allow only 95 lakh, even when you follow the accrual system of accounting. Are we clear? Next adjustment. The income from medical college solely for educational purpose is 10 lakh. Gross receipts of college for the year 100 lakh. Yes. Gross receipt would be included. Why? Yes. What will you do? Yes, students. This will be included, it will not be included. Where will you include this?
So included in 425 lakhs. Already
No,
included in.
425 lakh. This is separate. But whether this is exempt, this is not exempt. Think about it.
It is solely for educational purpose, so it's excluded, I think.
Yes. But what are the exemption? Let me take you back. What did we discuss here? Educational institution which is existing solely for education, or medical institution or hospital where the annual receipts are less than 5 crore, and this should be the combined receipt, right? Now in our example, if you look at it, whether the combined receipts are less than 5 crore, the gross receipts of college are 100 lakh. Gross receipts of the hospital is 425 lakh. So whether the combined is less than 5 crore? Yes? No, right? So this will be taxable. So income from medical college solely for educational purpose, this 10 lakh amount which is there, this will be taxable amount, right? So the gross receipts of the college, 100 lakh, therefore we need to add over here. Are we getting this? So here, therefore your calculation will change. So 425 minus 3 lakh plus 100 lakh. This will be 522 lakh. Right? Plus income from business minus 3.4 lakh, 520.6 lakh. And from this, you will calculate the ad hoc exemption of 15%. This comes to 442.51 lakh. Are we clear? Yes or no? As the gross receipts of hospital plus the educational more than rupees 5 crore. Are we clear? Okay. Now, gross receipt given in one above includes a sum of 55 lakh which has accrued but not received. What will happen to this? Yes. Will be included if it's following accrual, yes, but this can be considered as deemed application if you make or exercise the option by filing the form 9. Right? The form 9. Are we getting it? So the gross receipt, if it includes 55 lakh, which has accrued but not received, in that particular case, you can consider this as deemed application by filing form 9. So here, I'm so sorry. Yeah, I'll consider here deemed application. Income accrued but not received. Now this to write in the notes has to be filed before the due date of the return of income. Although the section says before the 2 months prior to the due date, but the CBDT has extended and allowed to file this by the due date of the return of income. You have to write these points to fetch the full marks. So you have to write that the form 9 has to be filed 2 months prior to the due date of return of income, but the CBDT has extended the due date of filing 9 up till the date of the return of income. So even if form 9 is not filed 2 months prior, but filed till the time the return is filed, it will be eligible for claiming the deemed application. The deemed application will be allowed. Are we clear? Now, if this 55 lakh has to be utilized by the previous year 26-27 or 27-28, if it is not utilized by the previous year 27-28, in the previous year 27-28, this will be considered as deemed income taxable at the rate of 30% under 115 BBI. This is how you will write your notes in the exam. Yes, Siddharth. Very good. Fine. Further, a sum of rupees 18 lakh was received only on 31st day of March 25. What about this? Yes, this can also be treated as deemed application. Very good. So this also, the same thing will be applicable. For this, again, you have to exercise the option of form 9. Now, if in case, again, you have the time to apply this 18 lakh by the previous year, 26-27. In case you do not apply, this will be deemed to be the income in the previous year, 26-27. This is income received late. Are we clear? Now, the trust has set apart 80 lakhs for acquiring a building to expand its hospital. But the amount was paid in December 2025 when the sale deed was registered in its name. Yes. Can it be treated as application or not?
No, ma'am. When it paid, no, at that time that will take.
Yes, see, there are again two viewpoints with respect to this. So amount is set aside for the building. Now, even if you have not really registered the building, but it is set apart. Now, this is the principle of accumulation, right? Now, you can accumulate the amount for a specified purpose for a maximum period of 5 years. Provided you file the Form 10. Provided you file the Form 10 before the 2 months prior to the due date of return of income. The CBDT is again extended for that up till the date of return of income. So if that be the case, this will be considered as the deemed application. So this is again my deemed application if the amount is set apart for the specified purpose and Form 10 is filed before the due date of return of income and the return of income is also filed, then this will be considered as the deemed application. But if this is not utilized within the specified time frame or if it is misutilized for some other purpose, then it will be considered as deemed income in that particular year and it will be taxable under 115 BBI. Clear? In June 2024, the trust purchased and installed a new computer software for 28 lakh. The rate of depreciation is 40% as per Income Tax Act. Depreciation is not allowed, 28 lakh considered as application, right? So, my computer will be considered as the application. Are we clear? Depreciation not allowed. The trust incurred 35 lakh towards the purchase of laptops, computers and printers for the hospital.
Application, ma'am.
It will be application. So again, laptops, 35 lakh. It repaid the loan of 15 lakh taken earlier for the construction of hospital building.
Yes, we have to take, ma'am, this application.
Correct? So repayment of loan is considered as application. When you apply from the loan, it is not considered application. Let's say, for example, if the question would have given you that loan taken, let's say 20 lakh, applied for purchase of, let's say, purchase of furniture. This is not application. But repayment of loan which is there, that will be considered as application. So this 15 lakh will be my application. But you have to write that this should not be for payment to the corpus. This should not be for expenditure in cash more than 10,000. The TDS should have been deducted. The loan should have been repaid within the 5-year window. So you have to write all those conditions which are there for the repayment of the loan. Isn't it? That it should not be for any person referred to in section 13(3). Clear? Next, donation of 2 lakh towards the corpus to a trust registered under 1023C and another donation of 1 lakh paid by a bearer check.
Bearer check not allowed, but this corpus donation is allowed.
So, donation to the corpus of the trust is not considered as the application of the income. Are we getting it? So, if I'm making donation to another trust towards the corpus, that is also not considered as the application of the income. So, any donation corpus that I receive or I give, that is both not allowed. What I receive is not considered in my income. What I give is not considered as application. And donation by way of other than account paid check will also not be eligible for the purposes of the exemption. Are we getting it? So only what you receive should be other than the corpus, and what you pay should also be other than the corpus donation. So any donation which is made, any expenditure, any application which is made by other than the account paid check is not something which is to be allowed. Clear? So what does it say is basically that donation, what I give, should be without the other than the corpus donation. And even if that be there, then only 85% is something which is allowed. Are we clear? Any question, any doubt? Yes? Is this clear to everybody?
Means
So,
voluntary
yes.
donation is allowed, ma'am.
Yes, voluntary is allowed. So, under both the regime, corpus donation, what I receive, are not considered to be forming part of my income. Corpus donation given are also not considered application. Are we clear? Fine. So you can write here. This is not eligible. Now, if the question would have told you voluntary contributions made to another trust, let's say 5 lakh. Now, out of this 5 lakh, how much will you consider the application? Only 85%. Are you getting it? So, if it says 5 lakh is given, so for the purposes of my application of income, I will only consider that 85% is something that is applied. Beyond that, it is not considered. So corpus is not considered. Normal also only 85% will get considered. Beyond 85% will not be considered as the application of the income. Are we clear? Yes. Now again with respect to that, there is a CBDT circular which I would like to highlight to you. Now what does this CBDT circular provides? This CBDT circular says that when you apply the donations to another trust, only 85% of the amount paid or credited would be considered as the application of income. So the CBDT has said that the donations made to another trust shall be treated as application only to the extent of 85. It means that if I am donating 100, only 85% will be considered as applied. But that 15% which remains, rupees 15, right? These are also not required to be invested by me in the mode specified in 11.5. Because what will happen is, like if I have given 100, right? Now, if application is considered only 85, but what about the rest 10, rest 15? Will I be required to invest in mode 11.5? Answer is no. I can't invest because I have actually paid 100 rupees. So for the purposes of the exemption, 100 will be considered as exempt. Even though 85 is considered as application, but the CBDT has given the relief by saying that the excess 15 will not be considered as my income because I cannot invest that income. So if I show you one example over here as well, the CBDT circular which has given and it's present in your module also. So see, if my income is 300, right? Now 15% if I reduce, 255 is the income which remains to be applied. Now 100 is what I am making the donation to another trust. Now what is considered an application is 85. Are we clear? But what can I apply from 255? Apply only 85? Answer is yes. But what about the balance 15? Can I invest that balance 15? The answer is no, I can't invest in balance 15 because I have already donated 100 rupees. I have already donated 100 rupees, so I won't be able to apply the balance 15 from that 100. So what the CBDT says is that for the purposes of application, I will consider 300 minus 100. I will not consider 300 minus 85. So the balance 15 which remains, from that 85, that I will consider for the purposes of the application. So even though 85 is considered to be applied, but what I will consider for the purposes of the balance that I can actually do the application is, I will consider that 15 has also been applied. Are we getting it? So based on that, the remaining income which can be applied without accumulation, 15% of 170, not 15% of 300. Because out of this 300, 100 I have donated. So what did you consider earlier? 300 into 85%. But now what I have to consider, 200 into 85% is what I can apply. Are you getting it? And out of which ad hoc I can remove 30. 170 into 15%. Are we clear? Yes or no? So this may be accumulated without any limits, and the balance which is to be accumulated is basically the balance amount. So the exemption will be available on the entire 300 and not 300 minus the on the 15 also the exemption will still be available. Clear? So even though 85% is considered to be applied, but the balance 15% will not get taxed. It will be considered as deemed application. Clear? The last one, the building was sold for 10 lakh. It was purchased in 1213. Index cost 4.5. The amount of sale consideration was invested in new building for 13 lakh. Yes. Yes, please. What will be the capital gain? Capital gain will be 5,50,000, yes, but what about the exemption? So the exemption, if the whole of the consideration is invested in a new asset, then the exemption will be the entire amount of capital gain. So 5.5 lakh will be entirely exempt, right? Because as entire sale consideration is invested in new asset. Clear? Yes. And finally, do not forget, this is asking the total income. So you have to add over here at the end the anonymous donation of 3.4 lakh. This will be taxable at the rate of 30% under 115 BBC. This was my exam question and I forgot to add the anonymous donation in the exam. So don't make that similar mistake, right? Is this question clear to everyone? Yes? Shall we move ahead?
Yes, we can go ahead.
Okay. Yes. So let us move ahead towards the next part of the trust. Tax on accreted income. Now, this is applicable when the conversion of the charitable trust into a non-charitable organization, which means that if the registration of the trust has been cancelled or there is modification of the objects of the trust and the trust has not applied for fresh registration. So when the trust changes its objects, modifies its object, it has to apply for the fresh registration. Or if it modifies the object and it has applied for the fresh registration, but the application has been rejected. So then it will be deemed that the trust has converted itself into a non-eligible form. Or if the trust has failed to apply for the reapproval or renewal of the registration where the registration is due to expire, or the final registration is not applied where the provisional registration has expired. In these cases, there will be a tax on accreted income, which is called as exit tax. Now, what does this mean is that if the trust has been applying its income for the different purposes by, buying building, buying furniture, buying different assets, right? So what would have happened is all these years its income was exempt. Now it is converted into a non-charitable institution. So whatever income has been exempt over the period of years and now has been stored in the form of assets, we will tax the FMV of those assets at this point. That is the exit tax. That's the tax on accreted income, accumulated income. Are we clear? Or if the trust merges with any entity not having similar objects and not registered under 12AB, 12AA or 1020C. Or if the trust gets into dissolution and there is non-distribution of assets to any trust registered under 1023C or 12AA or 12AB within 12 months of the dissolution. So if trust dissolves but it doesn't distribute its asset to another trust, then it will be applicable. What is the tax on accreted income? 30% plus 12% surcharge plus 4% cess, which is 34.944%, which is there. And what is the tax on the accreted income? As I said, the accreted income is FMV of total assets minus total liability. It excludes the assets acquired out of the agricultural income, which is exempt under 10 because this was not the charitable income. Asset acquired out of income before getting the registration under 12AA or 12AB. Again, this is not out of the exempted income. Asset transferred to trust registered under 12AB. So if the has been transferred to some other trust, then of course it will not be considered as the accreted income. Are we clear? Shall we solve a question on this particular point? Yes, from the module itself. Is this particular point clear to everyone? Yes or no? Fine. So let us solve this question. Let me open up the question in the module. Yes. Helpage is a charitable trust set up on Fund for 2010 with the object of providing relief to the poor. Later, in April 12, it changed its object to medical relief. It applied for registration on the basis of its new object, that is medical relief, on 1/9/12 and was granted the registration on 1/12/2013, 1 Feb. On 1/4/2024, Helpage got merged with Poor Aid, is not eligible for registration under 12AB or 1023C. All the assets and liabilities of the Helpage became the assets and liabilities of Poor Aid. The trust appointed a registered valuer for the valuation of its assets and liability, and from the following particulars, including the valuation report, calculate the tax liability in the hands of trust arising as a result of such merger. Land is given. They have given the location, date of purchase, stamp duty value, FMV, and the book value. Shares are given. The type of the shares are given, equity and preference. Date of purchase, face value, purchase price, price at which share is quoted on the BSE, open market value is given. And they have given the liabilities also. The book value of the liability is 120. This includes the corpus, provision for tax, and reserves and surplus. So first, what is the value of the land that we will take? Yes.
Open market value, ma'am.
See, here the fair market value would be the price that would the open market value will be there, right? But what does the provision say is that the fair market value of the land would be higher of the open market value and the stamp duty value as on the specified date. It says you have to take the higher of the two. It doesn't say only the open market value. So if you look at the provision which has been there with respect to the particular accreted tax which is there, now it says that the valuation rules needs to be considered. So what does the valuation for a different category of, they give the different valuations with respect to that. So let us have a look at the rules with respect to that. So if you look at here, first, if we look at the value of the immobile property. So the fair market value of an immobile property shall be the higher of the price that it would fetch if sold in the open market and the stamp duty value as on the specified date. Are we clear? What is my specified date? The date on which it converts itself. Right? So first of all, you will write in the answer that if a trust convert itself, it merges with a non-charitable trust, right? Then in that particular case, it will be considered that the accreted tax will be applicable under section 115 TD. If it merges with another trust which has the similar objective and it is also getting the registration under 1023C, there's no problem. But it is merging with trust which is not eligible for registration. Therefore, the accreted tax will be applicable. And the specified date will be the date of the merger. Right? So now we have to consider the higher of these two values. In respect of the quoted shares and the unquoted share. For the quoted share, they say that the FMV will be the average of the lowest and the highest price of such shares quoted on the RSE as on the specified date. Or where there is no trading, then the average of the lowest and highest on the RSE on a immediately preceding the specified date. For unquoted, they say that A plus B minus L into PV divided by P. A is book value of all the assets of that company of which I am taking the shares, plus B is the book fair market value of the bullion, jewelry, precious stone, and minus L is the book value of liability. PE is the total paid up share capital and PV is the paid up value of that equity share. And for other than equity share, it says it will be the market value. Are we clear? And with respect to the liabilities shall be the book value of liability, but will capital fund, reserves, contingent liability, provisions, other than ascertained provisions, and the provision for the taxes. Are we clear? So let us go back to the question. Why is it not going back? One second. Yes. So now what will be the value of the land which you will take? For the Gurgaon one?
120 lakhs.
120. And for Noida?
मीन्स वो नहीं लेना है मैम, 2010 का परचेस है.
Yes, that is correct. So if you see the Gurgaon one which is there, that you will take the 120 being higher than 100. But when it comes to land at Noida, now the trust was registered only on 1 February 2013, right? So what did we say? That assets will not include the assets which were purchased prior to the granting of the registration. Are we clear? And that is why in the exam, this is very important to have a look at the dates. This is purchased in 2010 and the registration has been granted with effect from 1 February 2013. So the Gurgaon one will be taken, but the Noida one will get excluded. Now coming to the shares, 5,000 quoted equity shares of A.
Average of highest and lowest, 310 rupees multiplied by 5,000.
See, here what we need to do is, with respect to the quoted shares, we have to take the average of the highest and lowest. You're right. So 310 being the average of the 300 and 320 divided by 2 comes to 310 multiplied by, this is per share. So you have to multiply by 5,000 shares. That will be the basically the quoted share value. What about the preference shares?
Open market value 180 into 2000.
Correct. 180 into 2000. What will you include in the liabilities? Now coming to the liabilities. So in respect of the liabilities, what did we discuss? That what we will not include is the corpus fund, whether we'll include it.
No, corpus,
Correct.
provision and reserves.
And the reserves and surplus. So from 120, you will exclude all that. So the difference between the two will give you the amount, and on that you will apply 34.944%. Are we clear about this question? Yes. Now the last topic that I will discuss with you is the registration of the trust. So the trust, before it commences the activities, it has to apply for a provisional registration 1 month prior to the commencement of the previous year. And the registration is valid for the 3 years from the AY in which registration is sought. If the activities are already commenced, then you don't need to go for provisional registration. You need to directly apply with the final registration within 6 months from the commencement of activity. And the final registration is valid for a period of 5 years. Now, if the provisional registration is going to expire, then you need to again apply for final registration 6 months prior to the expiry of provisional registration. If the expiry of the final registration is there, then you have to apply for renewal within the period of 6 months before the expiry. In case you modify the objects, then within 30 days of the modification, you have to apply for the fresh registration. In case you don't do it, that particular case, you will be considered that you've converted yourself into a non-eligible firm and the accreted tax will be applicable. Are we clear? So if the cancellation of the registration of trust happens, then the income of the trust is applied for other, so if the trust registration can get cancelled on occurrence of these violations. The income of the trust is applied for other than objects of trust. If the trust has business income which is not incident, separate books of accounts are not maintained. If the income is applied for private religious purpose or for any particular community, if the activities of the trust are not genuine and not in accordance with the registration, if the trust has not complied with law or has furnished the inaccurate information, this can result in cancellation, and if there's cancellation, there will be accreted tax. Clear? Now, last one is the taxation of the private trust. I think we have already done this revocable, irrevocable, right? We have done that if the assets are put in a way that the power to revoke is there, it will be considered as revocable, right? And in case there is no power, the settler does not derive any benefit, it is considered as irrevocable, right? Or if the income is arising from the assets transferred for inadequate consideration for the benefit of spouse or for the daughter-in-law, and if these assets are put under trust, then the income will be clubbed in the hands of the transferor. Are we clear? So when the settler puts the asset into the trust, section 47 says this is not considered as transfer. But this is only in the case of irrevocable trust. In case of revocable trust, the income will still be clubbed in the hands of settler. In the hands of the beneficiary, if the beneficiary is relative, the income will not be taxed because the beneficiary is relative, so 56(2)(10) doesn't apply. The income of the trust, if it is a specific trust, then if it is no business income, then the share of beneficiary gets taxed in the hands of beneficiary at slab rate. If there is PGBP, then it will be taxable at MMR. If it is discretionary trust where the shares of the members are not defined, the shares of beneficiaries are not defined. If it is PGBP or whether it is not PGBP, then it will be taxable at MMR. Are we clear? Any questions, any doubt? Last one, the political parties. For the political parties, income from house property, other sources, capital gain, voluntary contribution, it is exempt provided they maintain the books of accounts, the records of the contribution are maintained, the audit is done, no donation in cash more than 2,000, and they file the return of income. And the same also goes for the electoral trust. Clear? Do you have any questions before we close the session? Yes.
Ma'am, I have a miscellaneous question.
Sure.
With respect to the Saransh that Institute has come up with. So, for our applicable attempts, September 25, the ones which are available when it comes to direct tax also. So, are those updated ones? I mean, keeping in mind the cutoff date that we have, 20th of February. So all of the necessary amendments have been added onto it, or what is it? I mean, how to find out, how to differentiate? I mean, is it the new one or what is it?
So the amendments will be taken care of separately, as we have said, there will be a separate class for that as well.
Yes,
So
that
few
that
of
will be
the
taken care
notifications
of.
may, yeah, yeah. So few
But
notifications may
as far
not
as the
be present.
publication is concerned, including as a part of the publication, so that it helps in IBS paper also to carry the saransh with us. So is the publication out? I mean, with the necessary amendments?
You can check with the BOS only by writing an email. I'm not sure about it whether the Saransh is 100% updated up to 28th Feb. You can just write an email to BOS and they would, reply. Or in the next class, you can ask Aparna ma'am about this also. She'll be better person
Okay,
to answer.
okay,
Yeah.
okay. So BOS at the rate Noida, is that the
Yes.
one? Okay,
Yes.
fine. Okay, thank you so much, ma'am.
Or in the
Okay.
next class, you can,
Separately, the amendment
clarify with
session will
Aparna
be
ma'am also.
covered. That is a different thing.
Yeah.
I'm sorry.
Yeah. No
That is a
problem.
different. Okay.
Yeah.
Yes. Fine, ma'am. Okay. Thank you.
Any other question? Okay. So I would request that, this trust topic is very, very important. There are always, a lot of changes in this topic in respect of the amendments which happen. So please do solve the questions as much as possible for this because this can, give you the full marks. Like as I told you that I forgot to add anonymous donation in my exam and that would result, obviously deducting of the marks. So it is better that, you do consider solving as many questions, practicing as much as possible with this trust topic because if you do it fully correct, you'll be able to fetch full marks for it. So with that, I think we'll just close the session for today. And thank you so much. We'll meet in the
Yes,
next
ma'am.
class. Thank you, Siddharth.
Thank you,
Thank you
ma'am.
so much, ma'am.
Thank you. Good night.